Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Allpeter, and every week I sit down with people shaping the world of acquisitions, founders who cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Today's guest is Lane Carrick. Lane is a serial entrepreneur and turned M&A advisor whose career really started out in private wealth, hospitality, healthcare, and financial services, but he currently serves as the managing director of Optima Mergers and Acquisitions. Optima is a boutique M&A firm based in Dallas. They guide lower middle market business owners through the complexities of preparing for and successfully exiting their businesses. Lane has founded and sold multiple companies. He's chaired 2 banks, served as the CEO for several growth stage ventures. He brings the perspective of a seasoned operator into the deal-making process, understanding not just the financials, but the human dynamics, the strategy, the emotional stakes that define successful transactions. He's also an educator. So he teaches M&A and private markets at SMU's Cox School of Business, where he's been honored with multiple teaching awards. In addition to being a frequent guest on other podcasts, he co-hosts the Deal Table podcast, where he shared some hard-won insights from his own exits, as well as offering practical advice on how to attract some serious buyers and competitive offers. So we're really in for a treat today. We've got a professor, we've got a wealth manager, we've got a sell-side advocate. Lane, thank you so much for being on Build a Business Worth Buying.
Aaron, I'm so honored to be here. Build a business worth buying. That's what I try to do for a living, is help people that built a business worth selling maximize the outcome from that process.
Great. Well, you've exited a couple of businesses yourself. I'd love to start there. What did you get wrong the first time, and what do you coach founders to do differently now?
Oh my goodness. I probably did everything wrong the first time around. And I was, a wealth manager advising ultra high net worth families, sometimes about their operating businesses. But, selling a business, if you haven't done it before, is a unique experience. I didn't really know what I didn't know, which is the dangerous part, right? When it's the unknown unknowns, as Donald Rumsfeld said, that can get you. I think the first thing that I did wrong when I sold, the first significant transaction I did was the sale of my wealth management firm, Sovereign Wealth Management, to an upstream aggregator who then sold to Goldman Sachs. I had done some sub roll-ups underneath my platform. I got rolled up, and then they got rolled up. So I was in the middle of all of that activity. I decided to sell after the stock market had its third crash in a decade, the 08-09 market collapse, which was, remains one of the most significant financial events of this era, with the subprime mortgage bubble popping, credit markets seizing up, the economy going into recession. Every time the market went down, my business, which charged a fee that was attached to the value of the assets we were managing, my income was a little bit of a roller coaster like portfolios. And I remember my wife on one occasion asked me after the 08-09 debacle, you said, what's happened to our net worth? And I said, well, it went down a lot. She said, what are you doing about it? And I went, I'm hoping it doesn't happen again. She said, well, that doesn't sound like a very good plan. So in her own way, she helped me recognize that I really wasn't thinking clearly about my business and understanding, what was its value, and how could I recognize that, and what did I want to accomplish. And ultimately, I had a bit of a beauty pageant. I guess if you say, what did I do right? I identified the strategic buyers of wealth management firms at the time. There were a handful of roll-up groups around the country. They'd been calling on me, and I would entertain their calls because I was kind of curious about what they were doing. And I met with several of them, and I picked the one I felt was the best fit for me culturally and for my firm. And the deal was pretty straightforward. There was a multiple of our cash flow, and I could take stock or cash, but I couldn't take all cash. And so there was a mix. The valuation changed. The more cash you took, the lower the valuation. Mm-hmm. So the incentive was to take, all stock if you were willing to tolerate that. But I guess I would say I'm not sure I could define a specific mistake I made, but I went into the process of selling in a period of sort of emotional exhaustion from being a very tired operator who was sort of under duress, and I had to let some staff go. I'd lost some clients, which happens when stock markets crash, right? And you're an advisor. So I would say I kind of sold under duress. And if I had to do it over again with 2020 hindsight, I would probably say, let's take a deep breath. Let's calm down and let's let things settle. And I probably would have deferred the sale and done it from a position of greater strength than I did at the time. With that said, I sold, the check cleared the bank. I exited 1 year after the transaction was complete. I discovered what a lot of sellers do. I was used to determining the fate of the business and making all the decisions. Now I had a strategic partner that owned the majority of my company, and I was no longer the decision maker. And I realized I didn't really like that very much. So I exited after a year, and I'm glad I did because it allowed me to move on to the next thing. But if you want to talk about optimizing value, I would say that I left money on the table by feeling this compulsion to do a transaction.
That's really interesting. And I think I want to go back to a couple of things that you talked about, because you mentioned that your wife was really instrumental in helping you realize that you weren't seeing things clearly. I imagine that you were very busy at that time. You were working a lot. You were thinking things. You were trying to grow, take care of clients, all those sorts of things. And so what is it about perspective that is so hard for people to get when they're in the trenches trying to figure things out?
Well, I think that, and I think you touched on it in the introduction, a lot of the dynamic in a transaction that I see as an independent third party is that I don't have this huge emotional investment that a seller does. And so emotions can really cloud decision making. Sometimes they can have a positive influence on decision making. Sometimes it's negative. But I think when you're, in the weeds, so to speak, in the trenches, it's difficult to step back and sort of divorce yourself from the emotional aspect of selling a business. And typically, a lot of them are founder, owner, operators, and you tend to take a lot of things personally. But look, I've experienced that throughout my life. Where I have an epiphany where somebody says something in a way that shines light on something where I've kind of been in the dark. So I expect for the rest of my life I will have those momentary epiphanies. Not all from my wife, but I do see our journey in life as a constant learning process. I remember when I was in my early 20s and fresh out of college, my father was a real estate developer, and he did a development that was very successful, and he had a second phase of the development, and he decided not to develop it and sell it to another developer who then did quite well with it. And I remember kind of rebuking my dad, like, Dad, what were you thinking? And he said, well, you never go broke taking a profit. And if you're a real estate developer and you're always leveraged, about once every 10 years, you're going to go broke. So, I think sometimes people suffer from overconfidence. Sometimes emotions get in the way of good decision making. But I remember on that occasion with my father, he said, son, the older you get, the smarter I'll be. And he was absolutely right. When I was 21, I thought I was smarter than my father. And it didn't take terribly long for me to figure out that he was a whole lot smarter than I was. And at 66 years of age, I still feel like I'm learning and growing, and I hope that never stops.
Yeah, no, that's great. You mentioned emotion a little bit and kind of how more often than not that can lead you to make some bad decisions or to rush through deals. Do you see some of your role today as almost like a wealth manager, in the sense of a lot of times you're telling your clients, no, you can't touch your money. Like, we're not going to sell right away. We're going to hold back. How much of that has moved over to your sell side advising piece, where you're kind of telling people to stay calm, be a little bit more forthright, versus how much of it is strategy? I'm just trying to get a sense of what is the need that most people have when they are going through a transaction.
Yeah. So I would say there's a probably equal weighting between managing the emotional aspect of a transition and managing the technical, financial, legal aspects of a transaction. I've probably been involved in 30 over the past 5 years. Never managed one where there wasn't some sort of emotional crisis at some point prior to closing. It's a very intense process. I was telling a client yesterday that when we did the valuation on their business prior to taking them to market, part of what we do in the valuation is we look at the average time businesses in their industry are on market before they close. And the average in this case was 15 months. So we're 3 months into a process. And I was trying to ground that client in the reality that, look, we've got some prospective buyers and we have some offers, but, you need to understand this is a marathon. It's not a sprint. And I think a lot of times when they sign that letter of intent and they feel like they've got a deal, that they think they're close to the finish line. And as you well know, you're really just starting a process when you sign the LOI, and that process is a lot more intense than the pre-LOI activity, because in my space, which is sort of the $10 to $100 million enterprise value, I'm typically representing a founder, owner, operator who's never sold a business to a buyer who's private equity, who has a team of lawyers, a team of accountants. They're going to go through a quality of earnings analysis. They're going to go through intense legal due diligence. They'll have insurance experts evaluate their coverage. They'll have cybersecurity experts. So it's a really intense process. And I think particularly for founder, owner, operators, emotionally, they feel like they're being attacked. Why did you write this check? Why did you choose to use that vendor? Why did you use this capital structure? So helping them understand, first, somebody's writing a really, really big check for your business. And these are the questions they need to ask in order to be comfortable that they've mitigated and understand the risk associated with it. So, don't get mad at your money. Let's be calm and rational. I've had a lot of clients tell me, well, I'm not going to answer that. I'm tired of answering these questions. It's like, okay. So I think the hand-holding is really, really important. I did that well in wealth management, and it was a critical part of wealth management as well. You can talk about Sharpe ratios and alphas and standard deviations and all modern portfolio theory until, the cows come home. But at the end of the day, when the market's going way up or it's going way down and people are either driven by fear or greed and they're moving to extremes, trying to ground them into a more rational, thoughtful place is really critical.
Yeah, what are some of those other emotional crises that people will encounter? I mean, you mentioned that kind of at least once in the deal that there will be some sort of emotional crisis or breakdown happen. What are some of the other types of things that pop up?
Yeah, I think a lot of it is just, you said it, and I focus on this with my clients, is you have two jobs. One is to run your business. The other is to sell your business. Never forget the priority there. Run your business, right? And so run your business first, and then work on the deal. And it is a real balancing act, because, again, a lot of times these are founder, owner, operators. A lot of times they've grown the business as much as they can grow it. They're stressed out because they're not delegating, so there's a lot of owner dependence, and they're too deep in the weeds. And so trying to run that process, and a lot of times, Aaron, they don't want their CPA or their in-house COO, if they have one, or CFO, to know that they're engaged in a discussion to sell their business. Sometimes they do. A lot of times they don't. So the burden of due diligence falls to them. And in that case, my goodness, we'll get a due diligence questionnaire with a couple of hundred questions, on the quality of earnings, and we'll get a couple of hundred questions on legal. Some of the questions from legal will be the same questions that were asked for the quality of earnings, and they feel like they're answering the same questions. So I would say it's an emotional journey, and there's always a level of emotions involved. I think one of the dangerous things is that founder, owner, operators start believing that the buyer's the enemy, right? And they become adversarial. That private equity firm's trying to screw me. Well, they're writing you a $25 million check, and they really would like to understand this aspect of your business, right? And how that impacts their investment. So no, they're not bad actors. I understand you're frustrated by answering the question. So I would say that from a stress standpoint, emotional standpoint, you never really, let off the accelerator. It's just a matter of how anxious and stressed are you and emotional are you in any moment in time along the path. But particularly if they get to that mindset where they see the buyer as an adversary in this process, then it just becomes a grind. It's almost like sometimes you don't know if you're going to get to the finish line. I think there's a saying in the industry that every deal dies some number of deaths right before you get it to the finish line. And rarely, I've never had a deal that didn't appear to die before it got to the finish line.
Interesting. Yeah, I think everybody just probably assumes that you sign the LOI, you answer a couple questions, and then there's no hiccups, and they give you more money than they signed up for. That's interesting.
Yeah, that rarely happens, particularly the latter. You get more money than they promised. And, look, sometimes there are bad actors, among buyers. There are those that will try to, get an LOI on very attractive price and terms and then go through the quality of earnings and retrade the agreement. And they're using the Q of E as a, leveraging point to come back and retrade. Sometimes it's hard for me as an intermediary and advisor to the seller to figure out whether this is honest and sincere and something came up in the Q of E that adjusted the mindset and is appropriate relative to what we agreed to, or whether it is an opportunity to retrade an agreement down to a price and part of the strategy. I've heard, and I don't know what the actual numbers is. I think it was Will Rogers that said there are lies, there are damn lies, and then there's statistics. And so I'm not sure which one this is, at least a lie. But the belief is that in the lower middle market Mainstreet deals that only about 20% of sellers that hire a professional and go to market get a transaction. Now, they may come back to market, 2 more times and ultimately get one. But at any given period of time, the close rate is suggested to be 20%. That's not inconsistent with my experience working for 2 firms, a business broker and a large M&A shop prior to starting Optima. There are a lot of reasons for that, but I guess I would just say, regardless of the variables that inform that, if 8 out of 10 business owners that bring a business to market don't get a transaction, it just tells you how hard it is to take a business out, identify a buyer, negotiate the LOI, go from LOI to closing. And again, in my space, my challenge is I'm an intermediary between typically founder, owner, operator who's never sold a business and isn't sophisticated in the way of deals, to a private equity firm or family office who's very sophisticated, does lots of deals. I use the analogy, it's like bringing a knife to a gunfight. You're outmanned. So my goal is to be the intermediary that bridges that gap and helps explain to them they're not bad actors. This is the way deals work. This is what to expect. A lot of it is that educational piece. I have a process flow chart I give to my clients. I tell them this is what the process looks like. This is how long each part of that process should take. Once we sign an LOI, we're probably 120 days, no matter whether they say they're going to close in 30 or 60 or 90, it's probably 120 days. And I've certainly had LOI to closing be 6 and 7 months in some cases. So that's a journey.
Yeah, why do you think the success rate is so low? I mean, 20% seems like, of everybody who wanted to sell their business, I imagine some portion of it are people who didn't like the price, right? But how much of it would you say is people couldn't find a buyer, they couldn't agree on a price, or they just didn't really have anything that someone else would value?
It's all of those things. I would certainly say that I do think the industry that I'm part of, intermediaries, whether we use the title business broker, M&A advisor, investment banker, I think the industry does a very poor job of being honest up front. Maybe honest is the wrong word, but communicating accurately up front what we think the business is really worth and where it's going to trade in the market. What I've seen, it's anecdotal, but I think it's meaningful, is that people will take a listing even when an owner has an unrealistic expectation for the value of the business, because they believe that once the market starts communicating the true value, that the owner will adjust their expectations. I don't think that happens. Maybe it happens over a period of time and they come back to market after they divorce from that advisor. But generally speaking, I think if you don't tell them up front what their where you really think their business is going to transact and set that expectation, that certainly is a meaningful contributing factor. I think that a lot of businesses, and I sort of define the 4 pillars that determine whether you have a sellable business or not. Is it owner dependent? A lot of businesses in the lower middle market and Main Street are seller dependent. An entrepreneur starts a business. They don't want to delegate because they think, well, that person can't do it as well as I can, so I'll just keep doing all the stuff. And they really build a business that can't be scaled because it's all dependent upon them showing up every day and working. I use the question of, if you left for 3 weeks and without a phone, would the business be there when you came back? Some businesses wouldn't survive 3 weeks without the owner because everything flows through them. So owner dependence can be a challenge. You can get a business under an LOI, and then if the buyer realizes that the business is just an extension of the owner, if there's customer concentration, that's another pillar. I had a client a number of years ago who had 100% of their revenue was from a single client, Walmart. Well, that's great as long as Walmart continues to do business with you. But if they find somebody that'll sell it penny cheaper, and you no longer have the contract, you don't have a business. So customer concentration. Books and records is a huge piece of the equation. We have a client now that we signed up in February. This is July. We haven't brought them to market yet because we don't have good books and records yet. Their CPAs having to go back and compile balance sheets and income statements and other materials, because we can't take them to market and present them to buyers without that quality of information. And they just never did that. It's a family-owned business. They make a lot of money. Not really sure how much they make. They kind of manage the business through the checking account, but never ran a profit and loss statement in the history of the business. Business is, 30 years old. So if you don't have good books and records, or maybe more specifically, if you have bad books and records, the business broker or M&A advisor is going to take the representations that the seller gives them and turn that into financial statements they're going to provide to buyers. If those things don't align, if they start doing their due diligence and they realize that the quality of those books and records is poor, and they lose confidence, in the numbers that have been presented to them on which they've presented a letter of intent, they're going to walk away, or their bank's going to walk away. If it's the SBA, they're going to look at the tax returns and they're not going to accept add backs to sellers, to calculate sellers' discretionary earnings. So bad books and records, or a lack of good books and records, can certainly kill deals. And then systems and processes, which is kind of like owner dependence, but a cousin of owner dependence is, if all the systems and processes are in the seller's head, and it's not captured in a way where somebody can step in and run those systems and processes to get that revenue, each of those things sort of contribute to sort of chipping away at the confidence of a buyer. And the more you chip away at that confidence, the more likely it is they're going to walk away, or their lender is going to walk away. And a lot of deals in the lower middle market in Main Street are financed by the Small Business Administration and by banks and other lenders. Even private equity firms have investors they have to answer to, and banks that they answer to. And so if those things don't line up well, deals aren't going to get done. I did see a survey by Firmex, which is a vendor into middle market transactions. They have some products that they offer for intermediaries like myself, and they survey folks that do what I do. They said over the period they surveyed recently that 30% of deals fell out in the middle market. I'm not talking about the Main Street deals. I'm talking about the larger middle market deals. 30% fell out between LOI and closing. I mean, that's significant, right? If a third of deals are falling out between the letter of intent and larger deals, imagine what's happening on the Main Street deals, where there's a lot more opportunity for things to go wrong.
And so I guess, what are some of those differences that you would normally see on a Main Street deal versus middle market or VC deals? What's the same and what's different?
Yeah, so one of the things I like about Mainstreet deals, and I'll sort of define Mainstreet deals as any deal that can be financed by the SBA and down, right? The SBA 7A program, I think they'll loan $6 million maximum plus working capital. So let's just say it's a $7 million business by the time an investor puts equity in and they get they get working capital. So I would say 7 million and down. Those deals are owner operators who've never sold a business selling to a buyer who's never bought a business, who's going to be backed by the Small Business Administration 9 out of 10 times, right? The great part about that is the SBA is going to run that process in effect. They're going to do a valuation. They're going to have a third party value the business. If the valuation doesn't come in at the agreed upon purchase price, the deal's going to have to be adjusted down or it's not going to get done. I have a deal now that's probably a $5 to $7 million deal, and I had a national bank that's a large SBA lender give me a term sheet on the front end. That way I know how much it can trade for because I know how much the SBA is willing to lend on that deal. It's really helpful to me as an intermediary because I can go to my seller and go, hey, Aaron, you may think your business is worth $10 million, but the SBA is only willing to loan X against it based on your tax returns and your P&L and your balance sheet. So your buyer is going to be borrowing money from them, and this is how much they're willing to loan. So this is where you're going to trade. It creates a discipline. The SBA also has a process to go from LOI to closing, and they run that process. So it forces discipline upon both the buyer, the seller, and the intermediary because they really run the game. And that's where I don't know what the number is, but I'm just going to say anecdotally, eight or nine, out of 10 deals are done, by first-time buyer, first-time seller, with the SBA funding it. Where I like to play, and it focused with Optima, that 10 to 100 million. The reason I'm positioned there is those deals are too big for the SBA, and so the buyer changes. Instead of having a first-time buyer who's dependent upon the SBA. Now your buyer is typically private equity or family office. They're sophisticated and they're not constrained with capital in that, the SBA, when they make a loan on a business, they're looking at debt service coverage ratios. So basically, we're going to look at the historical financials. Hey, Aaron, that your business has generated, $500,000 a year of cash flow. And we're willing to make a loan to the buyer of your business such that, we have a 2-to-1 coverage of debt service from the cash flow of the business. So that means that, we can only loan X amount. But when you get a private equity firm or a family office or a strategic buyer, somebody that's the bigger fish in the industry, like when I sold Sovereign to a bigger fish in the industry, they weren't going to the bank and getting money. Private equity firm, particularly if they're funded. The last deal I did was with a private equity firm that had just finished a $400 million capital raise. They got $400 million in the bank. So they can negotiate a price that's not constrained by what the Small Business Administration says the value is and what the debt service coverage ratio is. They have their own discipline.
So I want to dig into that a little bit because when it comes to business valuation, this is something we hear a lot about, and there's lots of questions. And it sounds like SBA is pretty much open and shut, where it's going to be a multiple of cash flow. And so I guess like the rationale would be, why doesn't that hold for everybody? Why isn't everyone just looking at it and say, oh, we do 5X, we do 10X of cash flow? What is it that really motivates someone to pay more than that?
Yeah, so, there are different types of buyers. They're financial buyers, and the financial buyers are strictly looking at an internal rate of return. So, I tell clients that, 95% of all businesses, lower middle market Main Street, are going to trade between, a 2 and a 4 multiple of cash flow. 2 is sort of an outlier. 4 can be an outlier as well. The 2 has all those things I talked about: bad books and records, owner dependence, customer concentration, lack of systems and processes. The 4, has all of those things in a positive way, maybe is growing at 20% a year, right? And they get the higher multiple. But if you think about why is that? Why do businesses trade, at 3 to 4 multiple? And the answer is, if you think about it, if you wear the buyer's hat for a moment, a buyer is looking for an internal rate of return on their investment, and they have a universe of investments they can choose from. The risk-free rate of return is defined as the U.S. Treasury bill, and so you can go put your money in U.S. Treasury bills. I don't know what the yield is right now, but let's say it's 3.5%. You can go make 3.5%. You can start going up that risk curve, and you can go from that to junk bonds. You can go to small cap equities. You can go to emerging market equities. When you get to a business that's privately owned, which means it's illiquid, right? If 80% of business owners that try to sell it can't sell, this is an illiquid asset, a privately owned business. It's got all the operating risk of being a single business. It's got owner dependence risk. Even with a new buyer that's taking the place of the seller, still, if he gets hit by the bus, he or she gets hit by the bus, the business may not survive that. So what return does a buyer need on their capital to justify buying a small, privately owned, non-diversified business? And the answer is, if you pay a 4 multiple of cash flow, you're pricing it at 25%, right? If I pay $1 and I get 25 cents of cash flow, I'm paying 4 times that cash flow. If I pay $1 million for a business cash flow and 250,000, I'm buying it at 4 multiple. That's a 25% return, unlevered, on my capital. If I'm paying a 3 multiple, I'm pricing it for a 33% yield. If small company stocks have averaged a 12, 14% return, and you can buy them in a diversified way, and you can sell them anytime the exchange opens, what kind of risk premium do you need, to buy a small business? So I try to help my sellers understand that risk is being priced, and the more you can mitigate that risk, the more you can say, no, we don't have owner dependence. Let me show you that. Yes, we have good books and records. Yes, we have systems and processes. Yes, we have a growth plan and we're executing on it. We're going 20% a year. The more risk you can take off the table for your buyer, the higher that return is going to be. A strategic buyer, though, is somebody that's in the industry, that understands what that business is doing. They may have overlapping services that they can cut out of the acquired business, so they can centralize operations and support. So they can
effectively just a derivative on cash flow, right? Like their ability to improve the cash flow of that business by getting rid of some of the costs that you're carrying.
Yeah, absolutely. And so, they may be getting a new geography. They're adding top line and bottom line to their existing business. I had a potential buyer for a business I have in market right now who's in the industry. They are seeking to sell to private equity. They wanted to buy my client at a 3 multiple because they're negotiating to sell at a 6. So in their case, it was simply, we buy at 3, we sell at 6. And look, that happens. I deal with a lot of smaller private equity funds that play the alchemy game of, buying and building a platform of businesses where they're buying at a 3 multiple, 3.5 multiple. And when they aggregate them, size mitigates risk, right? A $100 million firm that's diversified is a very different animal than a $10 million firm, that has a smaller number of clients. Size matters, and there's a premium for size. So, private equity for the last few years has been chasing residential services. If you own an HVAC firm, you've hit the lottery, because there's a massive wave of PE buyers that are chasing that. Well, there's some smaller players that have said, well, wait a minute, I can go buy up these 250, 300,000, 400,000 sellers discretionary earnings, EBITDA, HVACs. I can put them into a platform, and then I can go sell them at 6 multiple, to an upstream private equity buyer. You just get a return for size. You're just getting a size premium, even if you don't improve the operations of the business. So, strategic buyers can.
Where do you see the biggest benefit in like the size curve? Because obviously, 100K business, very risky. Not going to be there. 100 million. Awesome, but hard to get to. Is 10 million the magic number, or is it like, oh, you gotta get to 5 or 30 or things like that? Where does the marginal benefit of being big begin to approach 0?
Yeah. So what's that optimal point on the curve? I would certainly say that once the buyer changes from being a financial buyer backed by the SBA, dependent upon the math working out so that they can manage the debt, and your buyer goes from being that independent individual to a private equity firm or family office, other institutional buyer, strategic buyer in the industry, you get a premium right there. And that size, I will say that private equity has been coming downstream over the last few years. And I think that's just because there's so many deals that are coming to market by people my age, this silver tsunami, as they call it, of people that, are ready to exit. I think I saw a stat that said, 1 million a year, will be looking to exit their businesses. And I think half the businesses in the U.S. are owned by people 55 or older. So there has been some movement downstream on this, but I would say that once you get over $5 million of EBITDA, you're probably looking at a meaningful multiple expansion, all things being equal. And that seems to be a size that where there's a switch that's flipped in the minds in terms of mitigating risk. Obviously, there are things that could alter the perception of that if there's customer concentration or, it's a dying industry or something. But by and large, all things being equal, I think when you get to 5 million of EBITDA, the game changes, the multiple changes.
Gotcha. Yeah. I've heard people throw out revenue numbers, but never an EBITDA number. So obviously that matters quite a bit based on your margins. So 5 million is a good rule of thumb to look at.
Yeah, I think so. I think it is. But look, that it changes by industry. To your point, I've got a client right now that has a 6% margin. It's a really, really good business, and it has a very high top line. But the industry they're in, it's a smaller margin. So I had a $65 million business that a $20 million business, a third of its size, might have an equal amount of EBITDA in a higher margin business. So revenues can be deceptive, but cash flow is king.
Would those deals get a similar outcome?
No, they wouldn't. This particular customer is in an industry that requires specialized knowledge. So I have a business right now that anybody could step in and run, meaning that it doesn't have this technical requirement that you have experience and knowledge of that particular business. So anybody that has good business sense who's willing to step in and learn the operations could operate this business. I've got 10 times the looks on this, and in the first 3 weeks in market, we had 4 offers on the table. The other one, it took 3 months to get 1 offer on the table. Because on the one case, I've got literally thousands of potential buyers that would say, I could go run that business, and I can afford that business, versus I don't think I could run that business. I don't know how to run that business. I will say that the street, so to speak, tends to be lemmings. They all tend to sort of, run off the same cliff at the same time. I've had that work to my advantage and a client's advantage. I transacted a commercial landscaping firm earlier this year, and that space was really, really hot. There's a whole lot of people chasing it, a lot of roll-up activity there. And so that worked to our benefit. We were able to go to market and have a robust, response to it. The industry and the business I just referenced, we brought it to market the week that Trump announced tariffs. It's a business affected by tariffs. That probably scared away half of our potential buyers, if not more, immediately, because now you've got uncertain cost structure. What's your margin? Well, I don't know what your margin is. And I don't know what it's going to be, because I don't know what your cost of steel is going to be, or how that's going to work out. So it's an interesting time, as we said in our earlier comments. It's a very interesting sort of backdrop of macroeconomic, dynamics today.
Yeah, no, I kind of want to go a layer deeper here as well, because we've talked a lot about how EBITDA is a major factor in how a business will be valued. You've talked a little bit about the modularity of the business, in the sense of how easy is it for someone to step in and absorb it and run it and take care of it. Is there anything else that someone should be looking at? Because I know some of our listeners may look at this and say, well, I can only get my EBITDA so high, but if I can, put more effort into modularizing my business, perhaps that increases the outcome I'm going to have more than increasing my EBITDA by 10%.
Yeah, I would say that if I'm a business owner and I want to maximize my value in the marketplace, there are only a handful of levers I can pull. And they tend to revolve around those sort of four pillars I described. Owner dependence, that scares away, no matter where you are in the market and size, that scares buyers away if they feel like the business is too owner dependent. So if I were running a business and I realized that everything had to flow through me, I'd be looking at bringing in support and, training people up and delegating some responsibilities. If you don't have good systems and processes, I would develop systems and processes in writing. My business, as it is today, Optima is, although I've been doing this a long time, as have my associates, the business is new. One of the first things I did was develop a flow chart of every aspect of how we get a client, how we bring them to market, how we present them to buyers, who those buyers are, how do we find them, how do we prepare the confidential memorandum, the teaser, how do these things get done, how do we negotiate deals, what are the best practices across our firm. So we did that as a starting point, not as, I'm ready to sell, maybe I better start putting some of this down. So systems and processes. Obviously, if you can increase your top line and your bottom line, your business is going, all other things being equal, your business is going to be more valuable. But how do you do that? I will say there are a lot of really talented people out there that are offering their expertise to business owners. I get calls from them every day. If there's an upshot to COVID, it is that there are a lot of ex-Bain, ex-McKinsey, ex-JP Morgan investment bankers, consultants that would rather work from home than catch the subway into the city and sit in an office cubicle. And they're willing to work on a consulting basis. So you've seen an explosion in sort of the fractional, C-suite players, and some of them can bring tremendous value. My general experience is that owners of businesses generally are one of two things. They're either really good at driving business top line, or they're really good at systems and operations, but rarely do you have someone who's great at biz dev and great at systems and operations. So one of the things I would tell a business owner is figure out which one you are, and then go get resources for what you're not, for your weaknesses. I would say the same thing to buyers of businesses. Instead of trying to figure out what business you think you'd like, figure out what your talents and skills are. Are you an operator or are you a biz dev guy? If you're a biz dev guy, go look for a business that has great systems and operations, regardless of industry, but doesn't have the business development piece. If you're an operator, look for something that has great biz dev, but through the use of new technology, systems, and processes, you could make it more efficient. I had a client earlier this year. They signed an engagement agreement. They paid the fee. We do a front-end valuation for them. We give them comps and tell them this is the range in which we think you'll trade. We're generally nobody's ever been outside the range that we've given them. They all fall within the range. And this client, when we gave them the valuation, they said we literally wouldn't sell for less than 3 times the valuation you've given us. And that's a bit of an outlier for me. Generally, the disconnect is a lot smaller than that. But in this case, they thought they didn't think the business was worth 3 times that, but that's where they would transact. And I said, well, look, here's the thing. The market is not going to go from a 4 multiple, to a 16 multiple or a 12 multiple, right? So the buyer's not going to change. Your business has to change to justify the valuation that you're talking about. So you need to get a, fractional executive in here, a business consultant, an exit planner, whatever they want to call themselves, that can look at the levers you can pull to build your business in such a way that you can grow your bottom line, so that with the market multiple, you can get that, 3 times where I told you your business is worth. But tripling your cash flow, that's not a change of the business. That's a transformation of a business.
Yeah. And if you're successful doing that in a short period, maybe they should keep running the business a little bit longer.
Well, they could make a living going and telling other people how to do that, right?
For sure.
If you can accomplish that.
One of the things that you've talked about a couple of times, I really want to make sure we dive into, is this importance of driving a competitive process. And I think every business owner out there would love to have, the beauty pageant sort of thing where everybody's got escalating offers and I've got 15 to choose from and it's really easy. I'm going to imagine that that's probably not what it's like for most people. So how do you go about creating that competitive process and sustaining the momentum that you have as you may have something that goes for 15 months?
Yeah. Well, time is the enemy of all deals. The longer the time goes on, the more frustrated the seller gets. And I told a seller this week, I said, I would think of the process we run as being like putting your house on the market. Once you put a sign in the yard and you're in the multiple listing service, if you haven't identified a seller and a buyer in the first 30 to 60 days, you're probably in for the long haul, right? Because everybody that's interested in buying a house in your zip code has probably seen it, in the MLS or driven by and looked at it. And if they're not buying, you're dependent on a new buyer coming into the market, and that can take a long time. I had a deal that was completed 2 years after I took them to market. We did have 2 different offers fall out along the way, and part of the reason was because this was post-COVID. They had a huge post-COVID bump, and then they had a crash back down to earth, and then they had a rise again. And so when you're underwriting that, when this was a bank financed acquisition, and when you're underwriting that and you see that volatility, the lenders were backing away. But if you're going to sell your business, you need to understand, if you're intermediary, what process they do run and how they're going to get you in front of your ideal buyer, and negotiate the best possible price. Part of that is packaging the business up in a way that the market wants to see it, which, sounds a little corny and simple, oversimplified, but at the end of the day, having a professional memorandum, a professional teaser, having a virtual data room set up, so that when a client says, well, have you got an updated income statement, or have you got a customer concentration, you got an AR aging list, knowing what the market wants to see to value the business and having that ready to supply to them so that it's not dragging out the process and you're not having to constantly go back to your client and ask for it, sort of getting all that lined up. We have a third party that we pay to compile a buyers list for us of ideal strategic buyers. They have a database of 15,000 strategics in various industries. And our belief is that strategic buyer who's not constrained, who can pay a premium price for the business, is who we want to be in front of. And we do a targeted outreach to them, and we do that before we do a larger distribution. So we want to sort of get it in front of them. We may have some buyers. I get calls every day from buyers saying, "Hey, I'm looking for this type of business. Would you show me deal flow if you see it?" Mm-hmm. And we'll keep a running database of that. So we'll go look and say, "Hey, we've got a towing company, coming to market. Have we had anybody inquire about that?" Well, yes, we have. We've actually had 2 family offices that have said, "We're interested. If you see something in this space, we're interested." We'll go to them first. Then we'll do the outreach to the ideal strategic buyers that have been identified. And then we'll do a broader outreach to, we use axial.net, which is a portal that buyers can sign up for. They're vetted and approved to, engage on the platform. They provide their criteria, what they're looking for, and we take a listing and put it on Axial. We get matched with people that have expressed a specific interest in the industry that our client's in. So we have a systematic process that we go through. It's fair to say that if you're competing to buy a business, you're going to make your best offer. We are certainly in a better position when we have multiple offers. From a ethics and professionalism standpoint, I'm not going to tell you, Aaron, that Joe over here has made an offer at $7.5 million for the business. That's not ethical. But I can tell you that, Aaron, we've got 3 other offers on the table. Your offer is not competitive at this point. If you feel like you can spruce it up and be more competitive, we'd be pleased to have you revise it.
Yeah. So, once you get to the point where you have multiple offers, how do you coach a founder to choose the right buyer, not just the highest bid if that's not the right thing for him?
Yeah, so it depends on the specific situation. The last two deals I did were what would be called majority recaps. So private equity firm bought 80% of the company. The founder, owner, operator kept 20% in the new business that was his business. And in those two cases, they changed their roles. One moved over to straight biz dev and got out of operations, and they dropped the COO in the day of closing. The other one was an architecture, engineering, design firm, and the seller was an engineer who said, I just want to practice engineering. I'm tired of running the business. And so, they stayed in the business, and now they have a partner, a controlling partner, right, who owns 80% of the business, and they're under an employment agreement with them. So in that case, we had multiple offers in each case. We actually had a client who turned down an offer that was several $1 million higher in cash at closing to take the offer from another firm who had bought a business in his industry, grown it, had an exit 5 years later at a much higher price, and that he felt more comfortable sitting in the room with, frankly. These were people he thought I can work with. The others, he wasn't sure. He didn't have confidence in them. So I've had clients literally take much less cash to partner with somebody. Now, if you're leaving, I have a deal in market right now. The seller's exhausted. He wants to hand the keys to the buyer and walk out the door. And so in his case, unless he has unless it's really important to him that he protect his employees, which oftentimes it is, and he wants to try to find a cultural fit, all things being equal, he'll take the highest bid. So there's a balancing act there. I try to be honest with my clients about these are the things you might consider when you look at these various offers. And if you're going to stick around and work with this person or group for a period of time, you better make sure you feel like you can be in the office with them every day and get along because they're your partners.
Yeah, it makes a lot of sense. Lane, this has been a fantastic episode. Thank you so much for all the wisdom, all the insights. We have two questions that we like to ask our guests on Build a Business Worth Buying. The first one is, what's the best example of a moat you've seen someone build?
So I have a business operator who provides a B2B services. He does corporate events and provides services around corporate events. And the moat he built is he dominates his geography. He has an 80% market share in the geography in which he operates. So if he has a client, and his clients are Fortune 500 companies, and they call him and say, I need this for this event, and he doesn't have it, he goes and buys it. Now, I've actually tried to wrestle with that because he has a much larger inventory than other businesses his size. But his philosophy is, if they call and I don't give it to them, they're going to go find somebody who will. And now I've just invited a competitor into my market. So his moat is, I'm going to provide whatever these clients need so they're never going to have to go ask somebody else for it. And it has worked. He has built a moat around his territory, which is a meaningful territory. It's a state. And he dominates that state. With that said, his CapEx, the amount he spends for that moat, is substantially higher than probably other people in his space.
Well, that's why it's a moat, is because it's hard to replicate.
Yeah.
Perfect. Last question is, if someone were starting out today, what is one piece of advice that you would give them to help them build a business worth buying?
Oh, wow. The one thing I would tell them is build the business as if it's for sale, whether you ever intend to sell it or not. Because if you think like a seller, you're going to think about, how do I put systems and processes in place, because that's going to be important to a buyer. How do I avoid everything being dependent upon me, because the business isn't transferable if it's dependent upon me. All the things we've talked about in this episode. I got religion on that early on. I picked up a book that sort of described how to build a business that has value separate and apart from me. And I was running a one-man service business at the time, and it was transformative. I started thinking about, well, if I get hit by the bus, there's nothing here. It's all dependent upon me. And I started thinking about systems and processes and owner independence and delegating. And so I would just say, have the mindset of a seller, even if you never sell your business, because you will run a business that has value beyond you at all times.
Perfect. Lane, thank you so much for being on, and thank you all for tuning in to Build a Business Worth Buying. Until next time, we'll talk to you later.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.